In this section, we will explain how the EMEA Credit Derivatives Determination Committee ruled that the takeover of Credit Suisse by UBS did not constitute a bankruptcy credit event that would trigger a payout on credit insurance linked to Credit Suisse. Credit default swaps, or CDS, are contracts that allow investors to hedge against the risk of default by a borrower. If a borrower fails to pay its debt obligations, the seller of the CDS agrees to compensate the buyer for the loss. The buyer of the CDS pays a periodic fee to the seller until the maturity of the contract or the occurrence of a credit event. A credit event is a predefined scenario that indicates that a borrower has experienced a significant deterioration in its creditworthiness. There are different types of credit events, such as failure to pay, restructuring, repudiation, moratorium, obligation acceleration, obligation default, and bankruptcy. Bankruptcy is one of the most common and straightforward credit events. It occurs when a borrower enters into insolvency proceedings in any jurisdiction where it has debt obligations. The insolvency proceedings must involve the appointment of an administrator, liquidator, receiver, or trustee to manage the assets and liabilities of the borrower. The question that arose in relation to Credit Suisse was whether the government-brokered takeover by UBS in March 2023 amounted to a bankruptcy credit event. The takeover was a result of a crisis of confidence in Credit Suisse following its involvement in several scandals and losses. The Swiss government intervened to prevent a systemic collapse of the financial sector and facilitated the sale of Credit Suisse to UBS at a nominal price. As part of the deal, Credit Suisse's shareholders retained some value, but its additional Tier 1 bondholders were wiped out. These bonds are hybrid securities that have both debt and equity features. They are designed to absorb losses in times of stress and can be written down or converted into equity at the discretion of the issuer or the regulator. The takeover of Credit Suisse sparked controversy among investors who had bought CDS contracts on Credit Suisse's senior and subordinated debt. Some of them argued that the takeover was equivalent to a bankruptcy scenario, as Credit Suisse had effectively ceased to exist as an independent entity and had transferred its assets and liabilities to UBS. They also claimed that the wipeout of the AT1 bondholders was a sign of insolvency and that Credit Suisse had defaulted on its obligations. However, these arguments were rejected by the EMEA Credit Derivatives Determination Committee, or CDDC, which is a panel of 15 representatives from major banks and investors that oversees the CDS market in Europe, Middle East, and Africa. The CDDC is responsible for determining whether a credit event has occurred and resolving any disputes or ambiguities in relation to CDS contracts. The CDDC ruled that the takeover of Credit Suisse by UBS did not constitute a bankruptcy credit event for several reasons. First, it noted that Credit Suisse had not entered into any insolvency proceedings in any jurisdiction where it had debt obligations. Second, it observed that Credit Suisse had continued to operate as a legal entity under UBS and had not been dissolved or wound up. Third, it pointed out that Credit Suisse had not defaulted on any payments or deliveries due under its senior or subordinated debt instruments. The CDDC also ruled that the write-down of the AT1 securities did not trigger a bankruptcy credit event on Credit Suisse's subordinated debt. It explained that the AT1 securities were too junior in the capital structure to affect the status of the subordinated debt and that their write-down was not caused by insolvency but by regulatory intervention. The CDDC's decisions were based on the definitions and rules established by the International Swaps and Derivatives Association, or ISDA, which is the trade association that sets the standards for the global derivatives market. The ISDA publishes a rulebook called the ISDA Definitions that specifies the terms and conditions for various types of CDS contracts and credit events. The ISDA definitions provide that a bankruptcy credit event occurs when one or more of 14 enumerated events take place with respect to an entity. These events include filing for bankruptcy protection, being subject to an insolvency order, making an assignment for the benefit of creditors, admitting insolvency in writing, being unable to pay debts as they become due, and having assets seized by creditors. The ISDA definitions also state that governmental intervention is not considered a bankruptcy credit event unless it results in one of those 14 enumerated events. Governmental intervention is defined as any action or announcement by a government authority that affects an entity's ability or willingness to pay its obligations. The CDDC applied these definitions and rules to determine whether a bankruptcy credit event had occurred in relation to Credit Suisse. It concluded that none of the 14 enumerated events had taken place and that governmental intervention had not affected Credit Suisse's obligations under its senior or subordinated debt. The CDDC's rulings meant that no payout on CDS contracts linked to Credit Suisse was triggered by the takeover. This disappointed some investors who had hoped to profit from their bets against Credit Suisse's creditworthiness. However, it also preserved market stability and avoided legal disputes over CDS settlements. In summary, we have explained how the EMEA Credit Derivatives Determination Committee ruled that the takeover of Credit Suisse by UBS did not constitute a bankruptcy credit event that would trigger a payout on credit insurance linked to Credit Suisse. We have also discussed how this decision was based on the ISDA definitions and rules for CDS contracts and credit events.